Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Sofi Technologies, Palantir Technologies, NIO, as well as Tesla. Our first article we will be analyzing is titled, "Is Sofi Technologies stock a buy?" So we'll be going over their latest news updates and the information you need to know as a Sofi stock investor. After that, we'll be looking at what experts believe this company should be worth in the future, and then our next article will be discussing if Palantir Technology stock is a good buying opportunity right now, considering the macroeconomic environment that we find ourselves in. After that, we'll move on and talk about NIO stock and how a top executive is very bullish and positive regarding their future growth sales, which should increase their overall share price. Lastly, we will discuss the latest news updates for Tesla regarding how analysts who are covering Tesla believe that investors should buy the dip ahead of their Q1 delivery results. And of course, this is going to act as a phenomenal catalyst, sending the TSLA share price even higher. So for more videos just like this one, remember to go and annihilate that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump right into today's stories. Sofi Technologies, if you didn't already know, is a fintech company or a financial technology company that operates an all-in-one inclusive digital app which gives their consumers everything they could possibly need in terms of financial services and or financial products. So in essence, this company is a digital bank. And right now, the banking sector is feeling the heat, considering bank runs that have happened, many banks going underwater and going out of business, as well as interesting government policies which have caused investors to scramble, and this is also pushing the Sofi share price further down. Now, the reason why the share price is up today is because recently they have entered into a banking network which gives their depositors access to up to $2 million worth of FDIC insurance, which truly differentiates themselves from other banking institutions. Normally, regular banks only offer around $250,000 worth of FDIC insurance, but now Sofi Technologies offers $2 million. So even if Sofi were to fail, you could be refunded up to $2 million, depending on how much money you had in your overall accounts. Despite this, the banking sector is very volatile right now, which includes Sofi Technologies, which is why over the last month, Sofi's stock has actually lost around 18% of its value due to this banking crisis. But just like every banking crisis in the past, this eventually will pass by us, making right now an excellent buying opportunity to buy very fundamentally solid banking and financial institutions. And here's why this author believes that investors should consider adding this company to their portfolio pertaining to Sofi stock. Sofi currently trades for just $5.75, and we'll go over their price targets, where some professionals believe this company could surge up to $10 by the end of the year. I also want to make it very clear that the other banks who are going out of business right now have a different set of clientele than Sofi Technologies. So it's not a fair comparison to compare Sofi Technologies to other banks like SVB, considering that Sofi not only has different clientele, but also a lot better risk management policies in place, which will essentially prevent Sofi from experiencing a terrible bank run. I also want to make you aware of that how regulators back in the financial crisis of 2008 and 2009 have actually put a rule in place to help prevent banks from going out of business by taking on too much debt with a little capital. And one thing that we can look at to determine if a financial institution is abiding by these rules would be their CET1, which is their risk-based capital ratio. And this ratio shows how equipped a bank is to endure financial distress. Essentially, we would want this percentage as high as possible, but as a regular metric, we would want this to be over 7%, because 7% is the minimum requirement for banks, meaning that this would be a healthy bank if it has over a 7% risk-based capital ratio. And if we look at Sofi's bank, they actually have a 14.6 risk capital base ratio, making this an extremely safe bank to invest into. And if we look at Sofi Technologies as a whole and not just their banking segment, we can see that it's a 20.3% CET1 risk-based capital ratio, which is almost 3 times the regular requirement. You can see clearly from the ratios on screen that SoFi is maintaining the ratios well above the minimums that regulators require, meaning that they are an extremely healthy bank. Now, this doesn't mean that SoFi is necessarily immune to the risk of a bank run, but it does mean that SoFi is in a much better position than the other banks that have gone out of business, such as SVB and the other ones that are experiencing distress right now that I mentioned earlier. We also know that the CEO is continuously buying shares of this company. Now, I don't want to get you all mixed up that not many other insiders are buying this company right now, mainly because executives commonly buy and sell shares that are already logged on a predetermined filing basis. But these recent purchases from the CEO were unscheduled, and this communicates to us as investors that the CEO believes the company is in good shape, that the company is not at risk for going underwater or out of business, and he's willing to put his own personal money where his mouth is because right now he believes that SoFi stock is undervalued, and many professionals agree with him. Right now, 8 experts who currently review SoFi stock have a buy rating on this company, while none of them have a sell rating and 6 of them have a hold rating. So these are very good ratings from professionals. On average, the company has a stock price target of around $7.54, which is close to $2.02 above their current share price, meaning that at minimum, investors can anticipate upside from this. Also, their short seller ratio isn't very high, only coming in at around 8.8 of their overall float, meaning that this company is very well positioned despite the overall banking crisis that is happening right now. For instance, JP Morgan has a neutral rating on SoFi Technologies and a $6 price prediction for this company over the next year. However, Bank of America has a price target of $9, which they increased from the previous price prediction of $8, saying that this company is a great buying opportunity for investors over the next 12 months. So take with that what you will, but overall, I would say SoFi is very well positioned despite the negative news that is circulating in the banking sector right now, and this just gives investors a better buying opportunity to purchase very strong fundamental financial institutions at cheaper prices right now. So make sure to do your own research on those. Up next, let's talk a little bit about Palantir, which is a big data and analytics company that serves both commercial enterprises as well as government clients. And essentially, Palantir interprets large data sets to where this data will be communicated to management so management can make the best data-informed decision for the overall company. And we are rapidly approaching the 3rd anniversary since Palantir Technologies, ticker symbol PLTR, has gone public. Over the last few years, Palantir's share price and their overall financial performance have been quite volatile. But here is what you need to know if you are invested into Palantir or if you are looking to invest into Palantir, which is also an artificial intelligence company. The main risk for this company would be that they didn't follow through with their overall promises. And I've talked about this in a plethora of previous videos, but I do want to make sure that you're aware of this. Back in 2022, Palantir said that they would grow at a 30% CAGR in terms of the revenue from now until 2025. And this is no fault of the overall management because Palantir came off of a lot of enthusiasm for their revenue growth, which clocked in at around 41% year-over-year growth in the year of 2021. So, over the next 4 years, they believed the company could bring in a 30% CAGR, which at the time did align with their financial metrics. However, as of late, the company is set to only bring in between 16% and 18% revenue growth over the next few years. So how is Palantir's growth going to impact their overall share price? Well, considering that we have entered into a very volatile time in the macroeconomic economy, and the general economy in the United States seems to be deteriorating right now due to high inflation and high interest rates, we need for the macroeconomic economy to rebound before we can see Palantir start receiving the fruits of their overall labors so they can increase that overall growth rate. Companies have recently guided for slower growth over the next few years due to these macroeconomic uncertainties. So Palantir is not the only one doing this and pulling back on their overall future guidance. Right now, the PLTR share price trades for $8.52, which is not bad for a PLTR stock price, but overall, many professionals believe this company could be worth up to $12 per share. But until the macroeconomic economy bounces back, we shouldn't see very strong growth in this company. Palantir is highly specialized, meaning that their overall technology doesn't come at a cheap price. Enterprises can purchase a monthly subscription to their Foundry platform for around $1 million a month, and this high price point excludes other potential customers and buyers because $1 million per month is pretty expensive for the majority of commercial businesses. So even if Palantir's overall products are fantastic, it's hard for these other companies to justify buying Palantir's expensive products and services during this time of economic volatility. So what should investors do? Should investors start buying shares today? Well, this would ultimately depend on your risk tolerance, your investing strategy, the current portfolio that you have invested, how allocated you are to this company, and a multitude of other factors which you would either need to look into for yourself or you would consult a financial advisor for that. However, let me add some good news. Professionals currently expect Palantir to grow their overall GAAP profitability at a very impressive rate. Right now, they are pegged to bring in an earnings per share of 20 cents, valuing shares at a forward price to earnings ratio or a PE multiple of 40, which is not necessarily that bad considering their overall growth rate. Palantir's future earnings growth and long-term potential is set to outpace their overall expenses. That's why experts believe their earnings per share could average around a 54% annual growth rate over the next 3 to 5 years, which is very good, and this is going to reflect very positively in their overall share price. In the end, even though Palantir needs to grow their revenue at a higher clip, which will happen once the economy bounces back, in the meantime, they are facing these economic challenges very well considering how they are growing their overall profits. So if you are a long-term investor, feel free to do your own research on this company. I personally only have around a 4% allocation to Palantir Technologies for my portfolio and another 4% allocation for my investment in Sofi Technologies. I don't believe in over-allocating more than a 5% portfolio allocation or percentage in my portfolio to single risky growth stocks because the majority of my wealth is either put into or has been caused by index funds, mutual funds, and ETFs. Some of my favorites, which I constantly point people to, would be SCHD, QQQ, and VTI. Those three ETFs are absolutely phenomenal and I think should make up some of the majority of people's core holding in the market if they want long-term, very stable, high growth returns. But nonetheless, let's move on to talking about NIO, which is an electric vehicle company located over in China, and recently a top executive, specifically their chief financial officer, is anticipating future growth. NIO's CFO is very confident that the company is going to achieve their overall 2023 sales goal of 250,000 electric vehicles delivered, which is very, very impressive. This data is going to be derived from Bloomberg, and NIO is anticipated to achieve 3 catalysts throughout this year. The first one would be releasing new models, the second one would be improved battery charging stations, and lastly, the company is set to build and improve on their overall battery swapping technology. Right now, NIO's NIO stock trades for $9.27. However, on average, professionals believe this company could surge up to $14.67. Even on the low end, multiple experts believe this company is worth at minimum $10 and at maximum around $25 per share. So if we average all of these out, we can anticipate around 58.25% upside over the next year if we invest into this company right now. However, the risks for this company would be that it's a Chinese company. So you're going to have to invest into ADR shares in a shell company to even access this company. And on top of that, if any geopolitical turmoil happens between the United States and China, we can anticipate that this company will drop in their overall share price. Now, some good news would be the prices of lithium are falling, meaning that it's going to be cheaper for NIO to make their electric vehicle batteries, which means that it's going to be cheaper for NIO to buy or make their electric vehicle batteries, which should increase their overall production efforts. At the end of the day, this should increase their overall performance both financially, which should increase their overall share price. So should we buy, sell, or hold NIO? Well, again, we don't want to over-allocate too much to a singular risky growth company, especially if it's a more speculative investment that's overseas. So I personally would allocate a 2 to 3% allocation to this particular company. Lastly, let's round out the video talking about Tesla, where analysts have said to buy the dip ahead of their Q1 delivery results. And honestly, I'm with them because Tesla right now is in a huge growth phase. Right now, experts and professionals predicted that Tesla is set to beat their consensus estimate of 420,000 units. Tesla's management is also very bullish, And they also say that they are anticipated to beat their overall metrics, which should move the overall TSLA shares higher in their overall worth. To quote from this article, it says that, "I highly doubt Tesla management would be so adamant on both the Q4 conference call and Investor Day that demand has been strong if Q1 volumes weren't good," end quote. Essentially, we know that Tesla will beat on their overall projections, which should translate to very high share prices for Tesla moving forward. It's always good when Tesla, or really any company, beats their formerly estimated metrics by experts and professionals. And not only are professionals saying, yeah, Tesla can beat these metrics, but also Tesla's own management is saying the same thing. At the current share price, Tesla is trading below $200 per share, coming in between $190 to $198. However, after they bring in their Q1 results, we can anticipate that Tesla will break that $200 price point, and then the sky's the limit from there. So I would love to hear your thoughts on Sofi Technologies, Palantir Technologies, NIO, and of course Tesla. Smash the like button if you haven't already. If you made it to the end of the video, don't forget to go and subscribe right now, comment your thoughts down below, and I will see you in the next YT video.